Hey, so welcome. So in today's video, I'm going to explain how you can leverage the power of the tax code to write off a variety of everyday expenses. So stick around to the end. I'm also going to be answering some subscriber tax questions I got on some of the last videos. So let's jump into this thing. So, So number one, employees versus business owners. So let's start with employees versus business owners. Not everyone is allowed to deduct the same expenses. So business owners generally have access to a much wider range of deductions compared to W-2 employees. And that's because the IRS sees business as like they see business ownership as a higher risk endeavor, and they incentivize entrepreneurs with more tax breaks to encourage business growth and job creations. I'll never forget it when I was like probably like year two of my businesses. I was talking to one of my old, he used to be a friend from college, and I was saying, I got a chance to write off this and write off this, write off this. He's like, what do you mean write-offs? Like, what do you mean by deduction? And like, he was an engineer, so he didn't really understand there was these different things, and because he never owned a business before. And I was just like, well, and this before I was, starting my tax strategy kind of company. It was like, I was doing more of like consulting, and I was like, oh, wait. So this is not something that everyone knows about. I thought it's just something inherently that like everyone had access to. Right. But that's because I had been a business owner for most of my life. I didn't never really thought about that back when I had a job. Right. So next thing is going to be like section 162A. So the golden rule. Now, here's the golden rule. Inside of section 162A of the IRS code, it says that business owners can deduct expenses that are ordinary, necessary, and reasonable in the pursuit of income. Now, the one rule opens up thousands of potential deductions for business owners just like you if you're watching this video. So let's talk about one. So one type of expense is the home office. So first, this is like the first common write-off, it's home office expenses. Now, if your home office is like your main place of business and you use it regularly and exclusively for your work, you can actually write it off. Now, it doesn't have to be like a traditional office space. It's a misconception a lot of people have. It could just be like as simple as a spare bedroom in this case. This is my filming studio, right? So I only film videos inside of this room inside of this Airbnb, right? Now, it could be a section of your basement. It can even be like a studio or detached garage, right? Just anything that's like dedicated strictly for like business. It's something that's really important. Now, when it comes to the home office deduction methods, there are two methods to claim the home office deduction. So there'd be the simplified method that lets you deduct like $5 per square foot, up to about 300 square feet. So that's about, you can take about $1,500 from that. Now, the regular method is more detailed, right? So you take a percentage of your home and you take the percentage of your home that's used for business and you apply it to your actual expenses like rent, utilities, and internet, right? So let's say that your rent is $1,000 and your home office is like, we'll say it's like 10% of your entire home, right? So that means that you can deduct about $100 per month from like your home and like from your mortgage or from your rent, right? That's just I know an example. I know most of you guys your house is more expensive than 1,000 a month, right? So but that's an example of how you do it. You take a percentage of your house that's actually used for business. That's a lot of these deductions is like a lot of people do it wrong. So they just like say, okay, I have a home office expense. Let me just take it off my whole home, right? Or they do like, a car, or they do like some kind of mile. Like everything they do is like they try and take the full amount, but it's usually just a percentage used for your business. Okay. So I'll give you an example. Another example is like laptops. So these laptops are generally essential for most modern business owners. And if you use your laptop for business, even partially, you can deduct that percentage. So for example, if you bought a $2,000 laptop and use it for 80% business, that's $1,600 in deductions right there, right? So do 2,000 times zero point 0.8, about 1,600. But again, most people will try and like take the full laptop. But if you're using it for a percentage that's personal, you can't do that, right? And it's interesting because it's like a lot of people like, the IRS is very fair, and they're giving you the ability to kind of do it. You just have to kind of learn how to weave your life into the tax code so you can get as much benefit as possible while still living a really good business life. Okay, another example could be your cell phone. So cell phones are another big one. Like just like laptops, you can deduct any portion of your phone used for business. And yes, if you use multiple phones for your business, you can deduct those too. Just keep track of how much is for personal versus business use. So a good example would be like if you own like a sales team and like that you have to like have like cold dials every single day. you can write that off, right? So right off the cell phone, right off the phone technology that's tracking the numbers. Like I use everything around that, right? Same thing if you have like maybe construction company and people that are going out into the field, right? They might have a company phone call they use only when they're at work. That counts as something that you can deduct as well. Okay. Another example is going to be your vehicle. Okay. So if you use your car for business, you can write off the vehicle expenses using one of two methods. The first is the standard mileage method. And for 2025, it's 70 cents per business mile. Now, the second is the actual expense method, where you can add up all the costs like gas, insurance, and then multiply it by your business use percentage, right? Same thing. So if you're using 80% for business, whatever your gas, whatever your insurance is, multiply by zero point 0.8, and you can use that for your write-off. Now, one bonus code that people use for that can use for like vehicles is code 179, and that's a bonus depreciation. So it's plus and it's one code 179 plus bonus depreciation. So section 179 and bonus depreciation, these let you write off a large portion or even all of the vehicle's like cost in the first year of it qualified. I was thinking of the 179 for like more of accelerated depreciation on a business vehicle. Now, that one can be extremely powerful. The thing with like the 179 is like every single year, it's like it changes, right? So I think it was back in 2022, you could write off 100%. And then the next year went down by like 10%. The next year went down like by another 10%. So depending on which year you're watching this video, it might be either higher or it might be lower, right? So that's why it's important to go and like talk to a tax strategist to like who's up to date. Like I know I'm up to date more than like the average person who's gonna be like in business, right? And it's like if you're not abreast to the different news, the different like press releases or updates, you're gonna like miss out. You might be using old tax information that can get you in a lot of trouble. And your CPA probably is not very well versed in. A lot of CPAs are more focused on compliance, not necessarily on tax reduction. Okay. So next thing is going to be meals. So in terms of business meals are technically and typically about 50% deductible, but they must have a clear business purpose, like meeting with a client or a team lunch, right? So during COVID, we had like 100% meal deductions through about the year 2022, but now we're back to about 50%. Now, one thing to know is like a lot of people kind of messes up because a lot of people will do like, they'll just go out to lunch with like their friend or, their parent or someone, and they'll be like, oh, I said one thing about business, right? So this is a business meal. Or they might not even think that, just think that I'm a business owner, I eat meals, I'm gonna be able to write that off. Now, again, it's kind of a gray area that some CPAs will try and like, kind of let you utilize a lot more meals. Like that's the first place to go if they need to find extra expenses. But if you want to do it by the book, you got to make sure you're doing about 50% and always make sure you keep records of who was there, what you discussed, and how much was spent, including the tips. Okay. And again, it's so important because like if you ever get audited, you need to make sure you have a record that's backing up whatever you claim, whatever you said was what you did, right? That's the biggest thing. You have to have a log. You have to have something to back up your numbers, even if you're doing stuff right, right? Because if you're doing stuff wrong, it's gonna be bad. But if you're doing stuff right and you have a log, no matter if you get audited, no matter what happens, you're always gonna be safe. Okay. Next thing is travel. So travel is one of my favorites. Now, if you're traveling for legitimate business purposes like meeting clients, scouting locations, or attending events, you can deduct airfare, lodging, car rentals, tips, and more. But remember, personal travel does not count, and you have to leave your tax home. So a lot of people, like, what they'll do is like they'll just go on like a family vacation. They'll try and write the entire thing off, but they didn't work on business the entire time, right? That's different than if you're going to go and speak at a conference in a different like state, a different country, or if you're going to be doing like a travel photo shoot. Or it's like, remember, it's like if you do a personal vacation, just remember the portion of the vacation that you do and use for business, you can write off. So you have to keep a really good log. Keep meeting minutes if you do a meeting. If you go see a client out there, keep like a log of which clients you saw, how long did you see them for, what did you guys do if you went out to go and eat, like keep track of it. Now you don't have to be like feel like you're inside of the actual like business meeting, like writing down the notes, right? You can do it retroactively. So you can just go back to your hotel later that night and just have like a recap. It's easy if you do it in the moment, have like a little, just like a little book, right? Because then you don't necessarily have to remember and track your memory, or if like something happens or if something comes up, it's very easy to kind of forget that and like you just forget to make your meeting notes and you can't really write it off as easily. Now, one thing that's important is you have to leave we call it a tax home. Okay. So when we say a tax home, it's generally like a localized area where your business is located. You can't just go, like, let's say that you're in like Lansing, Michigan. You can't just go up the street in Lansing, get a hotel for the weekend, and then write that off. You have to leave your city and leave your relevant tax home, right? So you have to kind of do some research to know what is your actual tax home, to know what is that radius that if you're inside of, you can't write it off, but if you are outside the radius, you can like kind of leave. That's one thing I was doing a lot during COVID. It was like I would literally just like trying to get out of the house. I would just go and find like the nearest place outside of like my tax homes. Like I'm in Michigan, so I would go to Ohio, right? And I would just literally just like do like videos. I would like talk to clients. I would do Zoom calls all day, and like that was basically like my office away from my office essentially that I would use, and it was really relaxing time. I guess to write it off on my taxes. Okay. So remember, know your tax home. It's really generally around the main area of like your workplace or business, so you have to leave it, okay? So your staycation down the road does not count. Next thing, so a subscriber Q&A. So I got asked this question, technically asked this question on Facebook last week, and the person's name is JC. So JC asked, can I use my crypto losses to reduce my taxable income? The answer is yes. You can deduct up to $3,000 of capital losses against other income, like your W-2 income or your 1099 each year. And yes, that can lead to a refund as well. Next thing, so key takeaways. So let's review. So section 162A is your best friend. Document everything. Know your percentages for mixed use items like laptops, phones, and vehicles. And don't miss out on deductions that you're entitled to. They can make a big difference in your tax bill. Awesome. So thank you so much for watching this video. Hopefully you found it helpful. Leave a like, drop a comment, and subscribe to the channel so you don't miss any future videos. I'm gonna be making more and more of these videos every single day. My name is Bryce. I'd love to be your tax strategist and see if I can help you. If you ever want some help building out a tax strategy to reduce how much you owe in taxes and make sure you can keep more of your hard-earned money, go ahead and click the link inside the description above or below the video to book a call with myself to see if I can help you inside of our tax strategy service. Okay? I will talk to you soon. Have a good rest of your day. Take it easy.